The market breadth continues to deteriorate. I think that is the problem, and that remains as the big problem. But at a time when we are potentially looking at trade wars smearing up or trade war fears which could haunt global growth, how should one view commodities and the underlying demand for iron ore? Amitava Mukherjee, Director of Finance with NMDC, joins us. Mr. Mukherjee, good morning and thank you for joining us. Really, if one looks at another blow for whale coming from the high courts in Brazil and firstly has hit the market already, and you've accounted for this prolonged period of iron ore supply. So what exactly is happening there?
I think this latest update from Vale is a little disconcerting, in the sense that originally we were expecting a 90 million ton cut from Vale. Now, after stock drawdown from Vale and other steel producers and certain swing producers going more, or even China, some of the mines becoming viable at this cost, one would have expected a net supply disruption of around 25 million ton annually on the global scale. Given that Rio Tinto and BHP would also not be able to apparently scale up their production because of certain damages to their port facilities due to cyclone, and FMG having gone on record saying that even they will not be able to augment their production in the very short run. So, taking all these things in the perspective, the original revised supply disruption was supposed to be around anything between 25 to 30 million ton. Now, this is a high-grade iron ore of very high-grade iron ore where the supply disruption is expected. So, yes, it will have an effect on the price. It definitely will have an effect of the price. But I am told that the Chinese are also now, because of the prices, shifting to a little lower grade iron ore as well. So, if you see the Fe58 movement in the world market, that is also moving up, because certain Chinese producers are also now focusing on low grade iron ore rather than the higher grade iron ore. So, 58 movement is also up now. And of course, the 62, both the benchmark prices have reached 93. There are speculations, if such disruptions continue, that in the short term it could even touch 100. But that would be essentially short term. In the 2-year term, the expectations are supposed to be around, the new equilibrium should be around 75, 76 somewhere, which is substantially higher than the previous pre-disruption estimates of around anything between $60 to $65 a ton. At the new equilibrium of 75 plus in around medium term of around 2 years is substantially higher than that. You would also realize that the premium for the 65 is also expected to go up to around 20% from 62, and the discount for 58 is coming down to around less than 15%. It is expected to hover around 10 to 15%, anything between 10 to 15% in the international markets. So yes, in the short run there are certain turmoils as and things come, but overall I think it should be, the latest estimates are the disruption would be around 25 to 30 million tons as compared to last year. But if you consider that in fact this year it was originally projected that the supplies would go up by 25 million ton globally. So the difference between the expectation earlier and now is actually 50 million ton. So that is something that would have effect on prices in the international market in the medium and the long, in the medium run, of course, yes.
Right. You know, the US-China commentary is not looking great. Given the impact of US-China trade war on the steel market, to what extent would you say that India's iron ore market could be impacted?
Yes, you see, the steel market, normally the China FOB prices for hot rolled HRC is around 530. That's the FOB price normally we are taking right now. And of course, as you know, the domestic prices in steel of US hovers around 780. So China had a huge price advantage even with all the ocean freight being there. Of course, the US to have invoked 232, which is now, so they are protecting their market. As a result, what happens is that there could be diversion of steel which is not entering the US market to the Asian market and into India. That could have certain impacts, but yes, even we have certain anti-dumping duties and some import parity prices there. Yes, but how it will shape up right now, what would be the production surplus and what will be the seaborne trade? Seaborne trade is normally around 450 million ton a year in steel, of which around 200 is EU trade. So the actual seaborne trade is around, say, anything between 250 to 300, of which China accounts for around 50%, around anything between 150 to 200. Now, how much of this would be diverted from the US shores to the Asian and the Indian shores are a matter which has to be looked at rather closely.
Mr. Mukherjee, what is the demand-supply situation in India? Steel players are clearly amping up their capacity. We have NMDC and the Odisha miners as well increasing production too. Can you give us a sense as to what the situation stands at from your viewpoint?
You see, right now we are the second biggest producer of steel. Crude steel is around 107 what we produce, and around 146 is our capacity. So we are doing at around 75-76% capacity. Consumption of finished steel right now, India is third at around 97 million tons, and we are likely to overtake US by this year end and cross 100. US is around 100, but by this end of this fiscal, we are going to be the second largest consumer of finished steel as well. And there is a very steady growth in demand. India is the only country where the demand is growing by more than 4 to 5% and the production is going by 6 to 7%. Worldwide, if you see, the growth is anything between 0 to 1% or maximum 1.5%. China, in fact, it has plateaued. It is in 22 onwards, 22, 23 and then 24, 25 onwards, it is supposed to be plateaued at, the demand is supposed to plateau at around 835 million tons of finished steel. That's the consumption. And production is also expected to sort of peak at around 950 odd, anything close to 950 odd of crude production. Now, Chinese, two things are also happening, as you know, that the Chinese have a policy of only not allowing capacity expansion. They are only allowing capacity replacement on a one-to-one basis. Among all the factors, the pollution factor is one of the main factors. But if you see, the Chinese have knocked off around 130 to 150 million ton of steel capacity in the last 2-3 years. And the estimates are that they need to knock off another 250 for the entire world global steel market to come sort of to come to a sort of an equilibrium. India is the only story in the world market which is expected to grow very healthily over the next decade.
So on an average, what can we expect in terms of the average realizations from NMDC, and what price differential now is between NMDC and the foreign iron ore pricing?
In the western coast, I think the imported ore would be at least 40% higher than us. My prices right now are around $40 at Bailadila, another $19 to the port at Vizag, that's $49, $2 to load it on the ship, that's $51, and another $8 to take it to the west coast, that's around $60. Today the prices, as you know, are $90 internationally, and if you bring it, that's another $5. So that's $96 of imported cost, imported ore at west coast, where we are at $60 on the landed price basis. So around it's as of date in today's prices, it is around 50% higher. The imported ore is around 50% higher than what my landed ore would be.
Okay, we're looking at ramping up the iron ore mining capacity from the current 43 million ton. When is it that it will materialize and by how much? And also, what is the update on the steel plant?
The steel plant, of course, is we hope to commission this in the second half of H2 of this current year, and activities are going on in that direction fairly satisfactorily. We will hope to commission that steel plant by that time. Mining, yes, we are going to almost not exactly double from the level of 36 to 37. As we said, we plan to do 66, 67. Both we are Karnataka, as you know, we have a Supreme Court cap of 7 million per mines. So most of this has to come from the Bailadila sector, and obviously evacuation is a major issue. So railways are doubling it. We are paying the money for the doubling of railway line. We are building a slurry pipeline of 15 million ton. We have already invested in that. Tenders are in place. Some of the tenders are in place. Others are being finalized, and so this ramp up capacity is there. Plus we are making a different what we call is an SP, or the these are we have two. We are making one more so that we can process more over there. Our crushing plant capacities have also been taken care of. So we are in line to have the infrastructure in place to do around 65 to 67 by 2022 or 2023. Subject to, of course, the environmental clearances and all those being made available to us, which hopefully we will get it anyway.
Okay, thank you so much for joining in, Mr. Mukherjee, giving us a sense as to how things are shaping up for the company, looking at a diversion of steel away from the US markets to India, talking about how imported iron ore is 40% higher than NMDC's prices.